I analysed 30,000 data points for 500 stocks over a 10-year time period to see what really drives long-term share price gains, and the results are awesome. I'm going to reveal those results and show you exactly how I'm using them to find great investments today. So what did I actually do? Well, let's take Microsoft as an example. I took the share price today, then looked back at the change in share price from 10 years ago to today, which was 1,196%. Yeah, seriously, Microsoft has had a good 10 years. Then I did the same from 9 years ago to today, 8 years ago, 7 years ago, and so on, right down to just 1 year ago, which was a 9% gain. I then did the exact same thing for 5 different key financials to see how much each of those had grown or possibly declined from 10 years ago, 9 years ago, 8 years ago, through to today. But of course, I didn't just collect it for Microsoft. I collected that set of data for 500 US stocks with some important caveats. They had to have positive earnings at the start of the period, so 2015, because if they were making a loss back then, you wouldn't be able to calculate earnings growth because there were none, which would render the whole exercise pointless. I also removed any stock from these sectors, because you can't really analyse them like you would normal companies. They require specialist knowledge. Take the basic materials sector, which might include a mining company, whose entire success lives or dies on finding the next mineral-packed mine. Great if you're a geologist and want to read through their research papers, but not so great for us because they don't really follow normal business rules. These sectors are too dependent on things like the cost of natural resources, finding natural resources, and interest rates that they require their own specialist analysis. So those 500 stocks I used, they were all outside of those sectors, and 10 years ago, they were all profitable. And when you look at a sample that large, trends start to be quite meaningful if you can find them. And the trend I care about finding is which metric has the strongest impact on share price growth. This is about understanding what it is that tends to propel a business forward. Imagine a business is this car. What determines whether a car goes fast? Lots of things, right? The tires, the aerodynamics, the gearbox, but above all, it's the engine, isn't it? Generally, the bigger and more powerful the engine, the faster the car goes. Other things matter, but that matters the most. So what is the engine of a business? Because once we know that, we can put parameters in place which help us identify the best engines, which in turn gives us the best chance of success in our investing. So the first step is to understand which of these 5 financial metrics tends to grow alongside share price growth. Because the more often that a single metric grows alongside share price growth and equally falls alongside share price declines, the more likely it is that that metric is having an influencing factor on share price growth. Just in the same way that if you had 500 cars, there would no doubt be a correlation between the horsepower of the engine and the speed of the car. So I calculated the correlation of each of those 5 metrics and share price growth over those differing time periods, which gave some very interesting results. And I'd say there were 3 quite clear findings. This chart shows the correlation between each metric and the share price. The x-axis shows the time periods, so the growth from 10 years ago to today, 9 years ago to today, 8 years, and so on, right up to just 1 year ago, which is essentially the last 12 months of growth. This y-axis shows the correlation coefficient. Don't worry if you're not familiar with that term, you don't really need to be. All we're looking out for here is instances where the correlation is above 0.3, because that would signal a reasonable positive correlation. Meaning if one of the things goes up, the other thing tends to go up alongside it. The higher the number, up to a maximum of 1, the stronger the relationship between those two things. So I'm going to mark 0.3 on the chart, and we care about metrics being above that line. Let's start with looking at the debt and how that correlates with share price growth. When we do that, we see there's only one period, the growth from 8 years ago to today, where debt did tend to grow alongside the share price. But for all the other years, that relationship was so weak, it just wasn't relevant. Now, I added debt to this analysis as a test, a bit of a sense check. Regular viewers will know I hate debt. Too much debt can kill a business. That's been very strongly proven. Now, you might expect debt to grow along share price to some extent, merely because the company itself is getting bigger. But you wouldn't expect debt to be a big driver of share price growth, because too much debt often inhibits growth, and this data, it backs that up. There is one time period where that relationship is moderate, but there is clearly not a strong positive relationship between debt and share price growth for the rest of the time. Indeed, in the short-term periods, 1 and 2 years, the coefficient even turns negative. So that's a good thing. We wouldn't expect debt to have a strong positive relationship with share price growth, and it doesn't, which kind of tells us the analysis is giving us sensible results. So let's move on to the more interesting financial metrics, the ones that we probably would expect to be drivers of share price growth. As we go through these, you'll notice a dip at the 6 and 5 year periods for all of them. I think it's no coincidence that those years were just before and during the COVID pandemic, where drastic share price changes were nothing to do with the underlying fundamentals, and that shows itself in the data as all the correlations drop. This is the net assets growth. And whilst we do see a relationship between net assets growth and share price growth over very long time periods, 9, 8, and 7 years, it sees a significant drop after that. So whilst interesting and potentially an important factor long term, it's kind of like the tyres on a car. Net asset growth will improve performance. It's clearly a nice to have, but it's not exactly the engine. So let's move on to the next two metrics, because when we look at net income, profit and earnings, and cash flow together, we see some pretty interesting trends. First off, they both have a pretty strong relationship with share price growth. Net income has a coefficient above 0.3 for 7 of the 10 periods, and cash flow, which is basically how much money a business brings in versus how much goes out, also has 7 of the 10 periods above 0.3. We can see that overall net income tends to have this slightly stronger relationship with share price growth. That is until we get to the very recent data here, the last 1 and 2 years. And what's particularly interesting is this huge difference on the 12-month period. Neither have a reliably strong relationship with share price growth here, but net income's relationship, that absolutely tanks. I'm going to come back to that later when we look at how to actually use this information to start searching for stocks. But I think it's a very, very interesting difference. Finally, we have revenue growth, which also brings some interesting results. 4 of the 10 periods lie above 0.3. It has a big drop around the COVID years, but unlike any of the other metrics, the relationship with share price growth remains in the shorter term, with a moderate relationship in the 3 and 2 year periods. Overall, revenue growth has a stronger relationship with share price growth than net assets, but it's slightly weaker than both net income and cash flow. So that gives us our answer, right? Net income, earnings growth, that's our engine. Well, not quite. Because that analysis is not the full story. Correlation isn't always the sole causation. Sometimes it's not the causation at all. There's more going on here. So far, we've seen that earnings and share price both tend to increase together. But what we haven't looked at is the influence that these metrics have on each other. So let's take the other strongly performing metric, revenue growth, and see how that relates to earnings. What I want to answer here is, does increased earnings cause revenue growth? Or does revenue growth cause increased earnings? Or are they simply unrelated? To do that, I split the stocks into 5 groups from lowest earnings growth to highest, and then looked at the average revenue growth for each of those groups. We can see here the results are quite linear. They increase steadily like a staircase. The higher the earnings growth, the higher the revenue growth, with the highest earnings growth stocks on average achieving around 16% revenue growth. Now, let's switch those round. This is where things start to get very interesting. This is the most important finding of the analysis. When we split the stocks by revenue growth and look at the average earnings growth for each group, the results are far more distinct. Stocks with the lowest revenue growth, they have hardly any earnings growth at all. They average about 1.5%, which, after inflation, is a decline. Whereas the stocks with the highest revenue growth, their average earnings growth is a huge 26%. When we look at these two charts together, it's abundantly clear that stocks with very high sales growth have disproportionately larger earnings growth, whereas stocks with the highest earnings growth only have marginally higher revenue growth. In other words, strong revenue growth, sales growth, more reliably lifts earnings than strong earnings lifts sales. The more sales growth you have, the more your earnings are likely to increase. Let me give you a simple real-world example of this, because once you break it down, it makes a lot of sense. Let's say I wrote a book and I wanted to sell that book. I find someone locally who will print it and they'll charge me $9.50. I sell the book for $10 and so I make 50-cent profit on every sale. In year one, I sell 10 of these books, which means I make $100 in revenue and I make $5 in profit. Then I find a different guy who will print the book way cheaper. Suddenly, my cost per book is just $5, giving me a profit of $5 per book. Year two, I sell 10 books again and make $100 revenue again. No sales growth, but my earnings are now $50. That's 10 times increase in earnings. But let's say at the end of that first year, instead of finding the better printer service, I actually decide to just focus on marketing instead. I stick with the original expensive printer, so now I'm back to only making 50 cents profit per book. But this time, I sell 100 books. My revenue grows from $100 to $1,000. That's a 10 times increase in sales. But my earnings also grow from $5 to $50, which is a 10 times increase in earnings as well. Can you see the difference here? In scenario 1, we 10x earnings, but sales stay flat. Whereas in scenario 2, we 10x sales, and by default, that also resulted in a 10x in earnings. Sales growth is intrinsically linked to earnings growth. In the first scenario, there's a ceiling. If that's the cheapest printer you can find, then from that point, your earnings can't grow anymore unless you grow your sales. You're stuck at $50 profit. But in the second scenario, you can keep growing your sales every year, never improve that earnings margin, but your earnings total will still grow. That's why the stocks with the highest sales growth in our data also had massive earnings growth. The data is showing us the basis of that book story happening over and over again in those 500 companies. Earnings growth, that is what we ultimately want. Profit is the point of a business and that will drive the share price up. But it's sales growth that allows for massive earnings growth. Sales growth is the engine. So what are the 3 things this analysis told us? Earnings appear to drive long-term share price growth for periods over 3 years and longer. But earnings do not drive short-term share price growth, periods less than 3 years. And most importantly of all, it's revenue growth which drives earnings growth. Regular viewers might have seen these trends before because it's very similar to these findings from Boston Consulting Group. In 1 year timeframes, they found most share price gains came from a change in sentiment, not changes to the fundamentals, but just more willingness to pay higher prices for the stock. We see that effect too, as almost all these financial metrics become uncorrelated in the 1 and 2 year periods, except for revenue growth, which is still correlated at the 2 year mark. Boston Consulting Group also discovered that as the timeline got longer, revenue growth became a more and more dominant factor, contributing to 60% of the share price gains once they got to the 10-year time periods. That's the same pattern we found. The longer the time frame, the more influence these metrics seem to have. And whilst earnings have the largest correlation, it is in fact revenue growth which drives those earnings to grow. Without revenue growth, earnings stay stagnant, and so does the share price, which is all great news for us long-term investors because it gives us some solid foundations to start searching for stocks. If we can filter down our initial search to those stocks which are very well placed to significantly grow their sales over the coming years, then we can tilt the odds of success in our favor quite considerably. So how do we do that? Well, this is how I do it, and exactly why I do it like this. And any metric I do talk about, you'll be able to find it on finviz.com. I'm not affiliated with them, it's just a really useful resource. This first parameter is super important to me in my strategy. It's probably the one which gets the most pushback when I talk about it on this channel, which is totally fair. I'm not precious about my investment strategy. If you don't agree with it, then that's fine by me. There are loads of different sensible investment strategies which work and are different to mine. But there is significant evidence to back up why I do this, and it makes your investment journey so much easier. I do think more people should consider it. Take a look at this chart. From those 500 stocks, I split them into 5 groups based on their sales growth for the first 5 years, so 2015 to 2020. I then plotted the average sales growth for the following 5 years for each group, so from 2020 to today. Check this out. Those with the highest sales growth for the first 5 years went on to achieve by far the highest sales growth for the following 5 years, like by miles. It's not even close. The top group achieved just over 14% annual growth. The bottom group, just over 4%. It's barely beating inflation. Even more interestingly, note how these two top groups are both drastically higher than the lower three. It starts to become quite a steep incline. So what does this tell us? Well, it tells us the same story I find every time I look at these kind of metrics. Past sales growth is the single best indicator of future sales growth. I've said that before, and often people's reaction is past performance isn't an indicator of future performance. But it is. Obviously not in every single individual case, but overall, it very much is. And again, let's break this down to something simple. Who would you back to sell more books next year? The guy who's been selling 10 books every year for the past 5 years, or the guy who's been increasing his book sales 30% every year for the past 5 years? The guy who's already been growing his sales every year, he's already figured out how to grow his sales every year. So he's much more likely to be able to sell more books next year than the guy who's never figured out how to grow his sales. And that simple story, it repeats itself in the data, even for mega companies. It's why on my free stock screener, which you might have used, if not, it's totally free, check it out. The two strategies I focus on, balanced and lower risk, both have a condition to filter down stocks by sales growth. I only look at businesses which have grown their sales by at least 50% in total over the last 5 years. Because that's one of the strongest indicators they'll continue to grow their sales. And growing sales is the main reason why earnings grow, which is the main reason the share price grows. It won't catch every successful stock, but it tilts the odds in your favor, and that's the whole point about setting these parameters. Let's look at the next one. This metric is also very important, but it comes with a warning because it is almost always wrong. This chart shows the percentage of stocks on the S&P 500 which either outperformed its future earnings estimate, met its earnings estimate, or underperformed its earnings estimate. The key thing to take away here is it's almost always wrong. These are all the times it was correct, pretty slender. These are all the times the estimates were beaten, and this is when the actual earnings fell below the estimates. They fell below about 40% of the time, and that's pretty significant. So there's your warning. I think earnings estimates are a little bit like the weather forecast, at least in the UK. It might say that it's going to start raining at 1 p.m. tomorrow, but we all know that it doesn't mean it will definitely start raining at 1 p.m. tomorrow. It might be a bit earlier, it might be a bit later, it might not rain at all. But it does give a pretty good indication. At the very least, we know it's not likely to be blazing hot blue sky weather. Earnings per share estimates are kind of the same. They add to the story of the stock. If the analyst's consensus is that a stock is likely to achieve a large 20% per year EPS growth for the next 5 years, then we at least know it's quite unlikely that that stock's only going to achieve 5% growth. It helps increase our confidence in the stock, even if it's not entirely accurate. And all importantly, it introduces that vital earnings growth into our parameters, which ultimately is what we want the stock to achieve. A combination of high sales growth and positivity about future earnings growth of a company is an exciting prospect. I generally want to see an expected annual EPS growth of 10% or more for the next 5 years. I think we saw a little bit of evidence in the data analysis which backs up this next parameter. Regular viewers will know that I'm very cautious about filtering stocks down by their current earnings, mainly because earnings can be inflated by things like one-off tax benefits and a whole bunch of other stuff, which makes them look a lot better than they really are. Uber, which I am invested in, is an example, where 60% of its latest earnings were actually from a one-off tax benefit, which won't happen again. I think we see some of this unreliability of short-term earnings in the data. In the 1-year time period, the correlation between earnings growth and share price growth absolutely plummets. But what's particularly interesting to me is that cash flow, a very similar type of metric to net income, is far more resilient. Whilst net income crashes to being the least reliable metric over 1 year, cash flow becomes the most reliable. Although important to say it's still far below our 0.3 threshold, so it's only the most reliable of 4 unreliable metrics in that 1 year time frame. Now, I'll be the first to say that's not enough information to provide a definite conclusion, but it does fit with the story of why I like to focus on current free cash flow rather than current earnings, at least to filter down stocks initially. Cash flow is a much more true representation of what the company is really retaining. It's the difference between how much cash comes into a company versus how much goes out, and it's far less likely to be misleading. It's a very true picture of how much money the company is making. I think that's why it performs well in that 1 year time period compared to the net income. I always filter down stocks to ones that are at least cash flow positive, so they bring in more money than goes out. I then compare that cash flow total against the cash flow being achieved by others in the industry. For example, Uber has the third highest cash flow in its industry, and there's 26 companies in its industry on the S&P 500. It's also the 56th highest cash flow business on the entire S&P 500, just outside the top 10%. Now, some people could look at Uber's revenue and profit and see it's only been profitable for a couple of years, and it's had this big one-off tax benefit for one of those, so maybe it doesn't look that strong, right? But if you look at the cash flow like we just did, you'll see they're absolutely killing it. Uber has all the money it needs to fund growth because they're already generating it themselves. On the reverse, you also get companies that appear to be profitable, but their cash flow is negative. That's not ideal. That situation can't last forever. It can be a bit of a red flag. So don't neglect to check the free cash flow. And also don't neglect this metric, because even if everything else looks good about business, this can kill it dead. Thousands of companies with great products have been killed by debt. A company with high debt, especially bank debt, is completely exposed to the whims of that lender. If the economy has a slowdown, or even worse, a recession, that lender is going to want their money back. It can be a huge inhibitor to growth. Now, some massively leveraged businesses, they do manage to outgrow their debt and do well over time. But it's such a big risk to long-term business growth. I avoid it like the plague, and I recommend that you do too. I wouldn't even entertain looking at a business with a debt to equity above 1, but ideally, I want that DE ratio to be 0.5 or less, and really, the lower the better. The current average DE ratio for my investments is 0.29. The highest is Amazon at 0.52, and Amazon are pretty financially strong, so I'm okay with that. If you want to be super cautious, which is often a good idea, you can compare a company's cash reserves and marketable securities, which are basically assets that they can sell really, really quickly, with their total long-term debt. If the business already has enough cash on hand to completely clear their long-term debts, well, then they're in a really, really safe position. These are my stocks. With that kind of cash to debt, at the very least, I can be confident those businesses don't need to worry about how they're going to repay lenders and can instead focus on growth. It's also a useful exercise to view this change over time. You might have noticed Uber is the odd one out here. Its long-term debts exceed the cash and securities value, although not by a huge amount. But if we look at the account from the previous year, we can see that actually cash and securities have both increased and debt has decreased. It's a good thing. It's going in the right direction, and combined with its mega cash flow, it paints a nice and stable financial picture, perfect for enabling future growth. And that's how I filter down companies to ones that should be in a great position to grow in the coming years. But it's not the only thing that matters, because if a stock is horrendously overvalued, it can grow as much as it wants, and the share price could still drop. So watch this video for a full description of how I spot overvalued companies to avoid investing in businesses that are doomed to fall, whether they achieve mega growth in sales or not.